India is cracking down on major players in the derivatives market. The Securities Exchange Board of India is planning to strengthen its surveillance measures for the derivatives market. On July 3rd this year, SEBI took one of the most aggressive actions against the US-based trading firm Jane Street. The firm landed in hot water in India after SEBI banned it from the securities market for indulging in manipulative trading practices that allegedly led to unlawful profits in Indian stock market. At the heart of this controversy is Jane Street's aggressive trading in the derivatives market, or what you commonly call it, the futures segment. However, reports say that Jane Street is planning to contest against the finding by SEBI, calling the accusations extremely inflammatory, and said that it was beyond disappointed by them. Now, what is this controversy all about? Why is SEBI cracking down on the derivatives market as a whole, and how retail investors were affected? Let me explain. Now, Jane Street is a proprietary trading firm that trades on its own capital. The firm allegedly made a staggering 32,681 crore rupees in profits as per SEBI. But how? So in the stock market, there is cash market and then there is derivatives market. Cash market is simple. You buy a stock or sell the stock in the market. Derivatives market is where futures and options are traded. Here you don't own the stock. Say for example, in futures you strike a deal today and buy or sell something at a fixed price later, while in options you have the option to back out, but in futures you don't. So SEBI's findings say that Jane Street's trade, particularly in the Nifty index futures, showed one pattern. SEBI described this pattern as non-neutral pattern, which is a strategic attempt to influence the market. So for example, in early hours of trading, Jane Street would load up and buy substantial quantities of bank Nifty stocks and futures. This buying spree would boost the stocks up. So traders would think, hey, this index will rise, and they lap up call options. Then Jane Street would quietly sell the call options to these traders and buy up puts instead. Once the traders are trapped, then Jane Street would flip the script. They dump all these stocks and then a selling spree would push the index back down. So then the puts that they had bought were a lot more, because remember, they bought puts and sold those call options to the traders. For more understanding, if an investor expects a rise in a stock, they buy call options by paying a small premium to the seller. If it rises beyond the specified price, then the investor gains. If not, then he loses the premium that he gave. Now, this not only influenced the index trajectory during expiry, it also gave massive profits to Jane Street and led to traders who fell for this in losses and losing hopes in the market. But how was it exposed? Well, long back, Jane Street had dragged Millennium Management, a rival hedge fund, to the court, complaining that Millennium had poached two of its former employees who formed a secret algorithm for them. Now, that algorithm would make a lot of money for them in the non-US markets, but the employees had switched and they took the secret formula with them. So SEBI got interested in this case and kicked off an investigation, pulling in Jane Street's profit and loss statements from January 2023 to March 2025. It disclosed that Jane Street was not always making profit, but all of its losses were offset by making profits from the bank Nifty options. So naturally, they zoomed in and found out two tricks that Jane Street had used. The intraday manipulation strategy was first, where they would buy massive chunks of bank Nifty stocks and futures early in the day and quietly place bets in the options, saying that the index would for later. Second was the extended marking the close strategy, which was used less frequently. So instead of pushing around the prices in the morning, Jane Street would wait till just before the market closes and aggressively dump bank nifty stocks and index futures and drag the index down and cash in from the options market. So now Jane Street and all of its affiliate companies are banned from the market until those allegedly illegal profits of about 4,800 crore rupees are recovered. As per SEBI's filing, NSE played a major role in highlighting the suspicious expiry date trading patterns by Jane Street. SEBI had asked NSE to examine Jane Street's trading activities in July 2024. NSE had then submitted a detailed analysis of abnormal trading, and it also issued a caution letter to Jane Street's local entities advising them to play fair. But the firms had ignored it and instead said that they are fully complying with the regulations. Now, this case is also highlighting the importance of a responsive and data-driven market infrastructure for the derivatives market. As per SEBI's latest study, in FY25, 91% of retail traders in the derivatives market lost money despite the crackdown in 2024 by SEBI. India has gone from being a small player in the derivatives market to the world's largest player in equity derivatives market in just 5 years. The daily turnover of the market now sits at around $3 trillion, which is down from $6 trillion before the crackdown though. But the demand has exploded as large number of inexperienced retail investors are now coming in to buy futures and options for quick returns, and the price is very much cheaper than buying stocks because they only need to pay for the contract, which sometimes costs as little as 10 rupees. But retail investors ended up losing more than $20 billion in option trades over the last 3 years, and it's clear because big players are gaming the market with billion-dollar algorithms that you probably won't even be able to see at all. So when you are betting on FNO, just know that you're betting against big players, not against fellow investors. Do your homework, and if you are not experienced, don't touch this segment. Rely on mutual funds and your financial advisors. You go to them for the advice. For more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.